all know, for those of you that are power users of the process, it's the particular moves in macro that matter, not the average of things or the simple moving monkey average of things. It's the particular things that happen at the particular time that help you risk manage your money. And again, that doesn't take a vacation. What that does is it's ticking live and daily every day of our good lives, God willing. Point number 3 this morning is the curve. Now, who takes you from global macro overbought, oversold, to copper, to fishing, to the curve? I don't know, and I don't care, but that's what we do. And you're going to get it from me, okay? So the curve is doing what? Wait on it. What we thought it would do. It continues to compress in quad 3. You know, that guy Rosengren, he's like, always late. And what happens here, and with his commentary, and I quote, he said, massive bond purchase are ill-suited for policy. Well, no shit, Sherlock. You're the one who implemented that policy. Now, what's happening at the Fed is that the Fed is starting to realize what we've been calling for since June of last year. Never mind January, February, March. Again, keep going every single month of this year, but that the Fed has been behind the curve on inflation. So what is most likely to happen here is what's already happening, which is the short end of the curve, which is signaling bullish trend on the bond yield, is going up at the same time that the long end, which is signaling bearish trend on yield, is going down. I have a bearish view, or at least a flattening view of the curve, because that's what my signals are saying, and that's what my model says should happen anyway during quad 3 stagflation. So the pressure continues to mount here, and I do think it's interesting ahead of Jackson Hole. The market may be getting ahead of this. Don't forget that a couple days ago, for real-time alert subscribers, you saw me cover my US dollar short. Well, why? Well, not because I like or dislike the dollar. It's because the signal told me to bloody well hit that, right? The fish is on. Make a move. What if the Fed ahead of Jackson Hole, or into and through Jackson Hole, continues to become as incrementally hawkish and talking about taper as they already have? Well, that you could easily have a quad 4 day. Now, I wanted to get on just not to scare the living shit out of you. Like, you wouldn't do that with the fish. You got to be quiet. So look at the setup. You could have a quad 4, 1 or 2, 3 day move like we had, don't forget, in July, where the Fed is the catalyst for that. So the dollar would go up, bond yields would go down, and everything that you're long gets smoked, other than things that are longs in both quad 3 and quad 4. So again, it could happen. It might happen. The probability just went up that it will happen. But you'll only know how I'm setting up for that if you're paying attention to the moves that I'm making and listening to what I'm saying on the macro show. So again, we'll see. It's something to think about. That's why I got on the call this morning instead of going fishing. Frankly, I'd prefer to have gone fishing, but I didn't, because I wanted to make sure that you're thinking. And I want you to think like a pro. I don't want you to hold your hand. Howard Stern doesn't have another Howard Stern. I'm telling you because it's time to pay attention to that particular point across all of global macro.
So maybe the short end of the curve can get to the top end of the range. Maybe it gets to 0.25%. Maybe it goes to 0.50%. Imagine that. That'd really flatten the curve. What happens along that way is that the market gets scared that the Fed's going to fuck up. Okay? Write that down. Yeah. They're like, oh, they're tightening into a slowdown. Because they are. Right? They're late to the party on inflation, and they're tightening into a real growth slowdown, which the long end of the curve is like, whoop, I'm going down.